We're joined this morning at TheStreet.com by One Stop Option Chief Market Strategist Alan Knuckman. Alan, thanks for taking some time out to chat with us today. I'm curious to know, we've seen some pretty big dives on the market. We've seen some retailers that are now underperforming. Sears just missed on earnings. Where are some good falling knives that you think that maybe investors should go out and try to catch?
Well, looking at some things that have fallen, I like Staples from a technical standpoint. I don't know about the business model, but Staples at this $11 level is a very key support. That was the breakout on the upside in 2002. Never looked back. So it's held a support in 2012. It's held a support so far as 2014. So from a risk reward, leaning on 11, I think is a very important level. We did not take out these lows with this last little surge to the downside. I also like Groupon, believe it or not. Groupon, technically speaking, $6 has been a pivot. It went below that here recently, but I think on a weekly basis you can look at $6. That's a very important level. But on this last low, we saw what we have as bullish divergence, meaning it made new lows, but we did not make new highs in the volatility. So that's usually the sign of a bottom. And lastly, and the biggest one is the VIX. The VIX has just been falling. It's at 1180. It's been trading between 12 and 14 for the last 52 weeks. Largely, we get these explosions, but it comes back in that channel. So if it goes to the downside below the 12 level on a closing basis here, then it targets 10. Now, we've been down to 939 back in 2007, so that's another 20% lower. There's more downside in the VIX, and that's still not very as complacent as we were way back when in 2007.
All right, good points all around. From an M&A perspective, I mean, just to mention, you touched on two companies that have been kind of mentioned on and off as potential targets. Staples was reported at one point by my colleague Dan Primack at Fortune to be a potential LBO target. And Groupon, obviously, is kind of in that same vein as Living Social, where they didn't really succeed, so to speak, but they still have very valuable technology and extraordinarily valuable consumer lists as well. I'm curious, you also mentioned a paper product stock that you thought was a potential winner. Tell me about it.
Yeah, it's complete opposite thinking. It's old has become new again. People are starting to respect yield and dividends stocks. So something like a Kimberly-Clark, and it comes in my diaper theory as well. As the economy gets better, more babies, more diapers. So looking at Kimberly-Clark, it's trading around 110. It yields 3%, so it's very attractive. It pays a lot more than a 10-year treasury. It's been trading between 102 and 114 since October. That target's 126. It's another 14% higher. So it's slow and steady. It's up 5% over this year in 2014 because of that shift from fancy shiny stocks into yielding conservative stocks, and I think this has some good upside.
All right, Alan, thank you very much for joining us today, predicting increased diaper duty for Americans. I appreciate you taking out some time to chat.
Thank you.